Okay, so thank you very much to the last panel. I think the message is definitely the case that it is worthwhile traveling or at least searching out Asian finance opportunities. And I'm sure once travel starts again, it'll be even more exciting. We're now moving on to our next panel, how to differentiate in hot markets with regulatory challenges ahead and new investments still distant. I suppose what we have in mind here is, when markets are good for particular sectors, they're good for all companies. When they're bad for particular sectors, they're bad for all companies. How then do you differentiate? Our moderator is Tony Foster, CEO and CIO of Marine Capital Limited. On our panel, we have Gary Vogel, CEO of Eagle Bulk Shipping, Bob Burke, partner and CEO, Ridgebury Tankers, Darren Maupin, founder and CIO, Pilgrim Global, and Sean Birch, Co-Chief Investment Officer of the Global Transportation and Infrastructure Division, Mount Street Group. Tony, please.
Thanks, Kevin. Good afternoon, ladies and gentlemen, if I'm still allowed to say that. For those of you who didn't watch the Masters yesterday, or maybe have never watched a golf tournament, you might not know that the best players come last on the last day, so you'll be pleased to know that you're in very good hands now. I thought that the title of this particular session was a bit wordy, to be honest, but I think Gary, first off, is very keen to tell you why he's able to differentiate himself in a hot market. So I'm going to give Gary the floor first.
Thank you. Yeah, I think you can actually drop the hot market. How to differentiate yourself is important in all markets. And first and foremost, it comes down to business decision. Where do you want to play? Where do you want to invest capital, and what are your competencies? And then it's about transparency, strong governance, of course ESG, inclusive of governance. And it's about saying what you're going to do and then doing what you said you were going to do. And I think doing that through the cycle, garners a trust from investors, and being able to deliver on that, and that return ultimately sets you up for the ability to raise further capital through the cycle, because we are in a cyclical market. No matter how long this strong market lasts, ultimately it's about being in a position to take advantage when the market backs off. So really differentiating yourself through just demonstrating what your core competencies is first and foremost in my mind.
And would you say that you get the shareholders you deserve?
Well, we have a lot of shareholders. I think in general, as I sit here today, I've now been at Eagle for over 6 years, and I think that we have an excellent group of really supportive shareholders that many of them have been with us through the evolution of the company. When I joined in the end of 2015, dry bulk markets were in a precipitous fall. We recapitalized the company in early 2016 and went right on very quickly after that, raising capital through 2 private placements, $200 million, and since then a number of other initiatives. And I think the answer is yes, because our shareholders have stepped up and supported us throughout this really renewal and growth, where we've done 49 S&P transactions and grown our fleet by about 20%, notwithstanding the improved market cap. So I'd like to say the answer is yes. I think we have good shareholders, and I'd like to believe we deserve them.
Darren, you invest in public companies. You invested in Eagle Bulk. You're also invested in Navios. Aren't you just invested because it's a cyclical play?
Well, that's complicated. Just because it's a cyclical play. We're distressed, deep value investors. We're not shipping specialists per se. But it has a lot of characteristics that can be attractive. And we were attracted starting in 2016 by the generational low in asset values. So typically what we do is we look for something that is really distressed, and then we try to find situations where we think we can't it's going to be really tough to lose money, and we'd like to partner with people who are really smart and who will treat us fairly. So, I mean, we've been invested with Gary since 2017. I think Gary's probably the best example of it. And, you know, it requires good capital allocation and treating your minority shareholders the way you want to be treated yourself.
Bob, do you think that public companies are good sellers?
No. First, I want to offer some sympathy to Kevin Oates. Kevin sends around 1 million emails to all of us about the panel topic, and about 3 or 4 of the panels have said, I don't exact crickets, no one answers. And many of the panels have said, I don't agree with the topic after being asked about it 10 times. But no, I think public companies have a bit of a different agenda than the private companies. They have to keep their fleets. Let me back up. We can buy an assortment of assets based upon how we see value at different parts of the age profile or the asset class. And most public companies have a story is not a kind word, but they have an investment thesis that they have to stick to fairly consistently. They can't be all over the place, otherwise their investors don't know what they're doing. They send mixed signals, and it takes time to change from A to B. I mean, Gary's done a great job over the past 8, 9 years, whatever it's been, completely transforming his company. But that took time, it took discipline, and it took a consistent message with his investors, and it's worked really well. You know, as a private company, we can quickly change, and we have. When we started Ridgeberry, we looked at the product tanker sector, and we bought a few product tankers, and we looked at where the market was going. We talked to our investors 6 months in and said, we need to buy crude. And they said, okay, and we just started buying Suez's very quickly, which, you know, we have the flexibility to do that. I have found the public companies to be efficient sellers when we buy from them. They're extremely professional, as opposed to some private sellers who will, you know, quite frankly, mess you about a bit and change terms. You know, when the public company wants to sell, they've made a decision, and they want to do it quickly, cleanly, and get the best price. So I find them easy to deal with.
Sean, wouldn't you say that points to the argument that ultimately shipping companies are not suitable for the public markets at all?
Good question. You know, I guess just to echo some of Bob's sentiments, our investors are across a multitude of institutional investors, high net worths, sovereign wealth funds, and whilst I have a public allocation per se, there's more value, we would argue, in a distinct and separate strategy in alternative investments, in which shipping would fall into that. And you know, I think one of the benefits of private investments across shipping is that we can be nimble, we can be quick, we can set up investment structures either within a commingled fund or a separate sleeve for particular investors that gives them direct access to a management team and direct access to some of the business decisions that go on managing those assets on a day-to-day basis. So there's direct involvement from the investors, plus then also, you know, they're also can see the immediate results because they're inherently within the deal and transaction itself.
Gary, I think you'd probably like to come back on that.
I would. I mean, you know, my previous company, 15 years of private company, and you know, I think to say that being, you know, that there's, you know, diametric opposition between the two, I just don't think passes muster. I mean, you can buy dry bulk and Eagle Bulk on a Monday and decide 2 days later to sell it, and there's no more, you know, quicker pivot from an investor standpoint. You know, we have the ability as an active owner-operator to, you know, pare down the size of our fleet. Of course, we could pivot completely, but we're focused exclusively on the mid-sized dry bulk segment. I mentioned we did 49 S&P transactions. 20 of those were selling our older, smaller, less efficient ships, but those ships were averaging 12, 13 years. We could be sitting here today with 80 ships. So I think it's about, you know, showing, you know, discretion and deciding what you want to be to your investors. But it's not just about scale, because like I said, we would have just bought ships and not sold. So, and if we really want, as an active owner-operator, we charter vessels in as well. So we could sell 10 ships and charter ships in for 3, 4 years and maintain fleet size if we wanted to. So I think it also goes back to governance. You know, there are public companies that have related party transactions with fees going out to related parties in terms of commercial management and technical management. You know, we don't have any of that at Eagle. So if we believe the best thing to do is to sell 15 ships over the next, you know, number of months, because that's our market call, then we can do that. And we're aligned with our shareholders in that regard. So I just don't see that it's a public or private. There are benefits to both, and I won't take you through it, but if I did, all the capital raising that we did, as I mentioned, $200 million right after we recapitalized the company, also through private placements, through overnights, and even today, we have an at-the-market in place. So if we wanted to issue $30 million of equity over the next few days, we could do so to buy some ships very efficiently at the market levels, and we'd report at the end of the quarter. So there's a lot of benefits of being public, too. So I don't think it's one or the other. I'll stop there.
Yeah, I agree. It depends upon who the investor is and what their objectives are. And so we can pat ourselves on the back. I mean, it all has to do with the management team and the governance, and to make sure that they're aligned and they act on behalf of the shareholders. That's the key. I mean, our investors want a private investment because they want more control. Other folks want to be able to get in and out and trade against the platform or take a directional view in the market. So they're two very different things.
No, it's exactly right. We have both investments, and it really depends on the situation, how we can best structure it. Can we find something better in public markets, or is it better to structure it privately?
What about, just to focus on borrowing for a second. So it's very often said that public companies borrow more effectively. Bankers love to lend to public companies. They assume that in extremis public companies can raise equity, which is maybe not always the case, but they make that assumption. But speaking from a private perspective, what do you think, Bob? Isn't it true that private companies can borrow just as well?
We can. I mean, Ridgebury can. A lot of private companies can. Of course, the public companies, the people who say that, don't know what our terms are. But there is certainly a gating issue for access to all kinds of capital, including debt. And if you're within the boundaries of what the banks demand as far as governance goes and ESG and you know, all the other essentials, then you'll have access to capital. Certainly being a public company helps. So does being a private company, you know, with good investors behind you and a proven track record of what those investors will do if there's a problem, and a management team that has responded over time proactively to you know, what the lenders expect you to do. So it's as much access to capital as pricing of capital. I mean, as a public company, as a private company, we don't have an ATM and a lot of the other things that Gary has access to. But we have shareholders with big wallets that we do talk to and say, we want to do something tomorrow or next week. And depending upon the relationship, you know, we have access to that kind of money. So again, it's very different. But, you know, it's a dodgy business, as they say. And we want to make sure we have the right shareholders who can behave correctly during a downturn, and the right banks, and vice versa.
So why ultimately are public companies still trading at a discount, generally speaking?
Well, there's a few things at play. First of all, they're not always, and we've raised capital at a premium to NAV. It's also not just about NAV. It's about where you're buying assets. It's about using leverage when you issue equity and put on leverage and buy assets. For instance, the dry bulk assets, we bought 9 ships in the latter part of 2020, early 2021 that have gone up by almost 100%. And so issuing equity at that time and using leverage to buy it has been very accretive to our shareholders, both the ones at the time we issued as well as the ones that came on board. And there are times we traded a premium to NAV. I don't think NAV is the be-all, end-all metric. Also, if we look back, you know, it's been a challenging decade. I mean, I'm a dry bulk, have been my whole career, right? It's been a challenging 10 years. And so it's understandable that it takes time for investors to believe that this isn't a blip, that the market is up, and that fundamentals are supportive of the rates that we're seeing. You know, we announced dividend policy on October 1st of last year, and the shares didn't move right away. But now we've paid, you know, 2 quarters of dividends. The yield has come down from over 20% to low teens based on the share price development. And so we think, you know, if people talk about seasoning, and I think it's not just about the dividend seasoning, but it's about earnings, right? And ultimately, one of 2 things will happen. Either these earnings will continue in earnest going forward and share price will reflect that, or investors, I don't think they are, but if the market were to back off, then maybe they know something that the market, that we don't see. But we think fundamentals are very supportive of, the order book is, as basically as low as it's been, and that we can go through all the host of reasons why, ordering a new building dry bulk vessel today doesn't make sense. So ultimately, I think this is a process, and the trend is very positive in terms of share price development, not just for Eagle, but for the other public dry bulk companies as well.
So most of the focus today has been on the environment and ESG in its various iterations. There is an argument that ultimately the focus on ESG and its essential incompatibility with what we do for a living forces shipping companies into the private market. Do you think that's a realistic possibility?
No, I think, just like the energy companies, they were out of vogue 6 months ago. In the U.S., they were screaming at the CEOs of the energy companies when they're going to stop exploring for oil. 6 months later, they want to know why they haven't drilled wells. So I think people are realizing that this is a transition. And although a lot of people don't understand this, when you transition from one place, you're going from one place to the next, and you really shouldn't leave the first place until the next one's developed. And, we haven't developed the other energy sources to the extent that we need. So I think, when people start to realize what it actually costs to transition, they'll be supportive. And if it makes financial sense, if the price is low enough, people buy.
Yeah, look, I think just to touch back on one of the earlier points around sort of bank debt in particular, the slightly different nuance on my side, just being on either the fund or separate managed accounts, the access to bank debt is a little bit different because the guarantee is back to the asset rather than a company, a corporate. But even against a container market, for example, older assets, the banks are there to lend. 100%. They recognise that the demand is there, the earnings are there, and the business model is good. So, Poseidon Principles and all the other pieces aside, these are still assets that need to operate, and people still need to make money, and investors want returns. And I think as you go forwards with some of these other sort of market segments, and we can invest across tankers, containers, dry gas, and we look at all of the spaces. And either banks are interested in lending, or even some of our investors, which are insurance companies, they have their own sleeves of debt that they also can lend, which can undercut some of the traditional banks. So there's always going to be an investor that's going to line up against these types of assets.
Yeah, I mean, I think it's true to say that private funds in shipping are still, in some ways, relatively new. A lot of bankers from an earlier generation said to all of us, we don't lend to funds. That's not what we do. We only lend to companies with corporate balance sheets.
That was definitely the case 10 years ago when we first got into this. The banks didn't want to know any funds at all.
One thing about NAV, Gary was saying before, as the politicians say, my views on NAV are evolving, and they've changed somewhat. I mean, NAV is the purchase price, and then a cash flow, and the third element is exit price, and then a discount rate. So the fact that one ship is sold for a certain price means that one guy in the world decided that ship had a cash flow and an exit price that he was willing to buy. I think some of the concern with buyers of public companies is that they never realize that exit value. So maybe that puts a dampening effect on what's so-called NAV. On the other hand, what buoys the S&P market is, the biggest fool in the world at that point in time puts a higher value on the exit price. So it maybe overinflates what the so-called NAV is. So again, I think there's a place for both of those, types of investments, and they serve different purposes.
Doesn't that speak to lack of understanding of the underlying business?
I don't think so. I mean, most ship owners at heart are somewhat of a gambler. And I think what the public companies provide is more of a trading platform for that asset class during a shorter period of time. They know they can get in and out efficiently if they have confidence in what the management's doing. Do you agree?
You know, I think we have many different shareholders. I mean, some of our larger shareholders have been with us for 5, 6, 7 years, and just fundamentally believe in the progression of the company and where we are in the cycle. So we also have, obviously, people who trade on momentum and want that liquidity, and something we've worked hard on to increase the liquidity so we can compete with the larger companies in that regard. But it really, you know, it really runs the gamut. I mean, as Darren mentioned, he's been invested in Eagle for a long time. So it's not just about people short term. You know, I do also think that the you know, NAV is effectively in some ways a breakup metric, right? It doesn't give you any value for the going concern. You know, we're an active owner operator. We've worked hard over the last 5 years to develop a platform that we believe has demonstrated an ability to outperform the underlying benchmark indices. You know, one of my first non-deal roadshows, an investor said, "What multiple do you want?" I said, "I'll start with 2, you know, just give us something for it." But over time, I do believe that investors are valuing that differential, and you know, at times it really shows, and then other times, of course, you know, given where public markets trade, you know, all companies are subject to the vagaries of that. But I believe you just continue to look to execute, and we look at Eagle, when we look to whether it's acquire assets, sell assets, the underlying premise is what will we do as a private company? Of course, we need to be aware that we're public, but we're not focused on the quarterly number per se. And I mean, a good example of that, and not to go on too long, but is we use derivatives to hedge market risk. We prefer to keep our assets and trade them, and so we use FFAs, and that creates some noise in the P&L on unrealized, you know, gains and losses quarter to quarter. If we were really focused on just that quarterly number, we wouldn't do it. But we believe strongly that it creates more value long-term over the quarters, over the years for our shareholders. So we take the time to explain it, and it's noise, and it creates sometimes issues with people saying, well, you missed earnings, or you overshot earnings, things like that. But ultimately, our belief is run the business as if it was like a private company within, of course, you know, reason, and explain why we're doing it, and I think we get value for that.
I want to say something about NAV because it's probably one of my biggest pet peeves in shipping. It's one of the most meaningless metrics. It's effectively just telling you that what the arbitrage is between public and private markets, but it's an arbitrage that you can't close. What's relevant is what are we paying for assets, and what are those assets going to return over their life? So NAV is the most widely used and least important metric that I read in shipping. Useless. Nearly useless.
Can you speak to some of our lenders about it?
You know, actually, I think it's an important metric for a lender, right? Because as a lender, I'd want to know if I ultimately had to sell these assets, you know, how much would I get back? So from a lender standpoint, but that's a lot different from an investor standpoint.
Yeah.
Absolutely.
What are all those notes? What's going on there?
These are my own.
So I think one thing we've been trying to explore is whether public company investors, I would say public company investors in particular, value shipping companies properly. Why do they often trade below NAV? I take Gary's point that sometimes they don't, and occasionally there's a premium, but that seems to me to be a relatively rare occurrence. I suggested to Darren that perhaps it's something to do with investors looking at cyclical plays. Could there be other reasons?
The investors don't trust management. And there are public companies that are strictly set up to feed the privately owned service companies of the management team. So why would you trust them? They have huge conflicts like that. I think that's the biggest problem. And all the cash goes out to the brokerage arm or the technical management arm.
And we know who they are.
It's undoubtedly a problem.
Yeah. Other than that,
it's a major issue.
Yeah. And yet we also know, we all of us know ship owners who have been in and out of the public markets for decades, still manage to raise the capital over and over again and still leave somebody else holding the baby. How do we shake off this bad boy tag?
With time and good examples. You need to see a reward. You need to see people like Gary getting a big multiple and being able to take advantage of it. And I think shipping's no different than any other cyclical, capital-intensive business in public markets. We've invested in just about everything over the course of our history. Mining, oil and gas, lots of asset-intensive businesses. And they all exhibit very similar characteristics. And when you go through a really long, protracted bear market, like we have in shipping, it takes time.
It just makes it easier for Gary and I to raise money if everyone else is, on the other end of the spectrum.
It should.
So I don't care about those people.
should.
If I can talk to my investors, and they know by meeting me and seeing my track record and talking to other people who have lent money to us or invested in us, and we have a good track record and reputation, then great for me. And if the other person doesn't, that's not my problem.
I agree with you there.
And shipping's still a very immature business in public markets. I mean, it's 25 years old. The business itself is thousands of years old, and public markets, it's an incredibly short list of companies compared to any other sector. I think this cycle is going to be very interesting to see if public markets really reward good governance and good capital allocation. I suspect they will.
Sean, do you have a view on that?
Yeah, look, I think it's right. But I think you're always going to get two sets of investors, one that is active and one that's passive. And the active investors are going to want to have some control over the investment decision. So they're always going to want to go for a separate managed account or a very bespoke or specific fund type vehicle. And others that are happy to leave the investments to a management team and will invest in the public market. But I think as my colleagues here have already suggested, its track record, its names play a very big part of that, and good governance, and which ultimately leads to results, the right results.
Yeah, I think it was Hegel who said the only thing we learn from history is that we don't learn from it. Mm-hmm. So, perhaps we all have a blank page from which to start. Yeah.
So questions from the floor, if there are any, please? No, one from me again then. We've seen over the years various companies, public, being able to raise finance which dilutes existing shareholders, but on the other hand, that type of finance is sort of readily sold to them by investment bankers who have investors ready to put their money into it. So, it's not only the sort of ship owners who are the bad boys, you could say, in the industry. It's also, there are others who are giving the industry maybe not the right reputation. Would you agree with that in some cases?
No, I think management's responsible. I mean, if you're the CEO of the company, you're responsible for whether you raise capital or not, and if it's accretive or punitively dilutive. And so, people can pitch things all day long, but at the end of the day, that's what good governance comes down to. So I don't think that's a fair assessment. I think it's been said a few times here. It's about track record, right? And the longer you do this, and being able to point back to say, we raised this capital and we did with it what we said we were going to do, and this is what happened. This was the outcome of that, right? And it's that ability. And I think circling back to ESG, right now, in the mid-sized segment, right, we can't be a first mover in terms of, zero emission, type technology. But we want to be in a position so that when we can, we're able to access that capital. And the best way we can do that is be a good custodian of our shareholder capital, good on execution, so that when we're in a position to invest and buy the first new building that Eagle will do, which will be in over, probably 15 years from the last time, that investors will say, yes, we want to put our money with this company because we know what they're going to do with it, and they're going to do what they said they were going to do.
I asked the question earlier, whether we get the investors, or shipping companies get the investors they deserve. I think it's probably the other way around. Investors get the managers they deserve.
And I think we happen to know shipping really well. So, of course, we see the bad apples, but there are a lot of good ones. And I think because, as Darren said, it's a relatively immature industry in the capital markets. It's very, sexy looking when it first started. It was subject to being ripped off by the investors being ripped off. And there are a lot of other, very famous flame-outs and potions sold to investors in other industries that we don't really focus on. So I think it's a matter of maturity and getting a bigger presence. And then the better teams can rise to the surface.
Okay. Is there a final question from the floor? No? Tony, have you got one more just to sort of quick across the board, or you've...
No, I think we're done.
You're done. Very good. Thank you very much.
Great. Thank you, everyone.
Thank you.
Yeah.